Right, so if you're watching this, there's a good chance you took out a fixed rate mortgage in 2020 or 2021 and you got a genuinely brilliant rate, 1.5%, maybe lower, some people even less. And now you're coming off that rate into a market where rates start with a 4 or a 5. Your monthly payment, if you do nothing about it, is about to go up by an amount that genuinely keeps people awake at night. So let me say this clearly up front. The shock is real. You're not imagining it. The maths is genuinely brutal for an awful lot of households this year. But here's the thing. The difference between handling it well and handling it badly is largely down to what you do in the 6 months before your fixed rate ends. Not the day it ends, the 6 months before. This video is the playbook. Start to finish, 12 minutes, take a brew, take a notepad, let's get into it. The first job before anything else, find out the exact day your current fixed rate ends. Not roughly, not sometime in December, the exact day. Open your lender's app, look at your last mortgage statement or ring them up and ask. Mark it in your diary. Stick a reminder 6 months before that date. That's the day we need to start everything. And if your fixed rate's already ended or it's ending in the next 4 weeks, you're already on the back foot. Not catastrophically, but you've lost the lock-in early window. I'm going to explain that in a minute, but talk to an advisor this week, not next month. Here's the single most expensive mistake that anyone doing a remortgage can make, and it's the most preventable. Doing nothing. When a fixed rate ends, if you've done nothing about it, the lender automatically moves you onto the standard variable rate, the SVR. And SVRs in 2026 are eye-watering. We're talking commonly 7 or 8% or higher, depending on the lender, which means your monthly payments won't just go up, they'll absolutely skyrocket. Now, here's the bit that catches people. Doing nothing isn't a deliberate choice for most of these people. They've meant to sort it out. They've just been busy. Life happened. Work was nuts, the kids had a thing, suddenly it's the week the fix ends and you're scrambling. 3 months later, you've been paying SVR for 90 days and it's thousands of pounds you'll never get back. The fix for this is the 6-month diary entry. Set it the moment you finish this video. If you've not done it already, set a reminder, make it loud. Future you is going to say thank you. Right, this is the bit most people don't know about, and it's the single most powerful tool you have, so I want you to listen to this twice if you need to. You can typically lock in a new mortgage offer up to 6 months before your current fix ends. 6 months. Not the week before, 6 months ahead. And here's why that matters. If you lock in an offer today and over the next few months rates fall, you can usually switch to a better deal before the new one starts. Most lenders allow it, so the offer you lock in today is the worst rate you'll end up with, not the best. Now read that again, the worst, not the best. And that's what an asymmetric bet is. Heads you win, tails you still win. Because if rates go up between now and your fixed rate ending, you've already protected yourself at today's rate. And if they go down, you switch to the better one. There is no downside to locking in early. The only people who don't do this are people who don't know it's an option. So step 1 of your strategy needs to be get an offer in your hand as early as you can. 6 months out is ideal, 5 months is fine, 4 months still works. After that, you're cutting it tighter, but it's still doable. Now, while the timing is the strategic bit, the paperwork is the practical bit, and it's usually the bit that slows people down. If you're employed, you'll need 3 months of pay slips, 3 months of bank statements for every account, and your last P60. If you're self-employed, then it's 3 years of SA302s and the tax year overview documents that go with them, plus 3 months worth of business personal bank statements. If you're a company director, salary plus dividends shown, and sometimes the company accounts, depending on which lender's affordability we use. Same list as a new mortgage, really. The difference is this time you might already have most of it. Gather it now, photo or scan it, stick it in a folder on your phone, and when your advisor asks for it, you're not scrambling around. And one absolute rule, do not take out any new credit between now and your remortgage completing. Not a SOFR on finance, not a new phone contract, not a car loan, not even a credit card. Lenders look at that credit profile right before they issue an offer. A new account in the previous month can sink the deal entirely. If you genuinely have to take out credit, talk to your advisor first. Much of the advice involved in a remortgage is exactly the same advice we give to first-time buyers. When it comes to your credit file, there are 3 big credit reference agencies in the UK. Experian, Equifax and TransUnion. Lenders use different ones, so checking just one leaves blind spots. Check My File shows all 3 in one report. There's a free trial, the link's in the description. I do get a small affiliate fee if you sign up through that link, it doesn't cost you anything. So what are you looking for in that report? Well, you're looking for old accounts that should be closed, addresses that are wrong, the electoral roll. Are you properly registered at your current address? Anything strange, sort the small stuff while you've got time. A clean credit file 3 months before your remortgage application is a different conversation to one cleaned up the week before. Right, now here's a decision that most people don't realise they're making. Are you going to stay with your current lender or are you going to move to a new one? Staying with your existing lender is called a product transfer. It's simpler, no new affordability check, and no solicitor needed. Often the paperwork is minimal because the lender already knows you. The rates are sometimes slightly less competitive than those on the open market, but the speed and simplicity can make up for it, especially if your circumstances have changed in ways that might make a new application awkward. Moving lenders is a proper remortgage. New affordability check, full application, solicitor instructed to handle the legal side. More work, but you've got access to the entire market, which is often where the best rates sit. Which one of these is going to be right for you depends on a few things. Your current lender's rates, what else is on the market, whether you want to borrow extra, we're going to talk more about that in a minute, and whether your circumstances have changed in any way that affects how easy a new application is going to be. A good advisor looks at both options and tells you honestly which is better. Sometimes it's the product transfer, sometimes it's the remortgage. There's no inherent right answer. It depends on the numbers in front of us on the day. There's one more thing worth knowing about, because for some of you, this is the single most useful idea in this whole video. If you're remortgaging, you've got an option to borrow more money than your current mortgage balance. It's called capital raising. That extra money can be used for home improvements, debt consolidation, buying out an ex, helping a family member with a deposit, all sorts of stuff. Now, I want to be a little bit careful here because capital raising for debt consolidation in particular is something that can save real money on monthly outgoings, but it comes with risks attached. You're moving unsecured debt onto a secured loan, which is your house. So this is not always good or always bad. It is a tool for the right person in the right circumstances. And with the right understanding can be the right call. And for the wrong person, it can be the wrong call. The same applies for what's called a hybrid loan structure, where part of the loan is on interest only and part of it on repayment. For someone who needs the monthly payment kept down through a difficult patch and has a credible plan to deal with the interest-only chunk eventually, it can be brilliant. For someone who doesn't, it's a problem stored up. This is where having a proper advisor earns its fee. You don't want a tick box firm pushing the cheapest option. You want someone who looks at your actual circumstances and tells you whether these tools are right for you. Where there's a will, there's a way, but the way has to be a sensible one. Right, the month-by-month diary. It's similar to what I've already covered. I did a shorts video on this. But quickly, here is the whole journey in one place. 6 months out, find the exact end date of your fix. Get a credit file check started. 4 to 5 months out, talk to an advisor. Have the conversation about product transfer versus remortgage, about whether you want to capital raise and which lenders fit your circumstances. Get an offer locked in. 3 months out, paperwork goes in, application formally lodged. 2 months out, offer issued. If you're moving lenders, get that solicitor instructed. If you're staying with the same lender on a product transfer, there's no solicitor needed. And finally, 1 month out, everything's set, waiting for the switch date. On the day your fixed rate ends, the new rate should kick in seamlessly. No SVR, no scramble, the whole thing's a non-event, which is exactly what it should be. So there's 3 things in all this that I want you to take away. First, the shock is real. If you're coming off a 2021 fix into 2026 rates, your monthly payment is going up significantly. And there is no magic trick that makes that not the case. What there is the difference between handling it well and handling it badly. Plan ahead, lock in early, get advice, don't drift onto that SVR. Secondly, you've got more options than you think. Product transfers, remortgage, capital raising, hybrid structures, term extensions. For the right circumstances with eyes open, these tools can keep households solvent through the rate shock. They aren't for everybody, and a good advisor will tell you honestly whether they're the right thing for you or not. And third, get advice properly from a whole of market advisor who can look at every lender, not just one bank. The cost of bad advice on a remortgage will compound over the next 5 years. The cost of good advice is genuinely small in comparison. If your remortgage is coming up and you'd like a no obligation chat, the links are in my bio to get in touch. 20 minutes, no charge, no pressure, absolutely worth it. I'm Patrick Weightman, your local East Midlands mortgage and protection advisor, serving clients up and down the UK. Drop me a like and a follow for more and hit the links in my bio to get in touch. And the obligatory, think carefully before securing debt against your home. Your property may be repossessed if you do not keep up repayments on a mortgage. Speak to you soon. Bye-bye.